Hello and welcome everyone. The CFA Society of India held its 7th edition of Wealth Management Conference in Mumbai recently. The event discussed at length the landscape of wealth management, right investment strategy, risk of macroeconomic accidents with wealth management and family office with industry experts. Money9 was at the event and brings you exclusive insights from industry experts. Today, Himali Patel speaks to Anil Ghelani of DSP Mutual Fund.
Hi, this is Himali Patel from Money9. Today we have with us Anil Ghelani, who is head of passive investment DSP Mutual Fund. He is also a director for CFA Society India. Welcome, sir.
Thank you very much.
So my first question, so what are your thoughts on today's 7th India Wealth Management Conference we had?
CFA Society India brings across a very great platform for wealth practitioners. Once in a year there is an annual event, and in my view this is one of the key events which, if it's there in your calendar, you get a very good level of knowledge enhancement of the latest trends in wealth management side. And also very important, I feel that it's a great platform where you can get a networking and learning from your fellow market practitioners.
Right.
So in my view this is one of the must attend events in the annual calendar for me.
Right, sure, sir. So moving on to next question. So passive mutual funds in India, especially in last 1 year, have massively grown and many new NFOs are coming with the passive funds. So according to you, what are the reason for the robust growth and what does it mean to the investors?
Structurally, if you look at it, when we talk about passive investing through index funds or ETFs, there are 2 or 3 key benefits. Point number 1 is that it has a investment style which is not having any human bias.
Right.
So in active management, the key element is a research inputs or individual inputs of a particular portfolio manager or a research analyst.
Right.
In passive funds, you eliminate that and you focus on some rule-based standard of investing.
Right.
So I believe that in the recent times, not only just 1 year, but I would say over the last 3 to 4 years, we have seen a very sharp increase in investments towards ETFs and index funds,
Right.
not just in India, but this is a global trend which we are observing.
Right.
So I believe that incrementally in Indian markets, there is still scope for generating outperformance or beating the underlying benchmark. But within that, especially for large cap space and little bit to an extent like a mid cap space, it's becoming more and more challenging.
Right.
Because of various reasons, like there is a vast amount of information available. Technology has changed the way in which information is processed very fast and absorbed. So because of that, actively managed fund managers using that research input,
Right.
they are finding it difficult to outperform the index, and hence investors are demanding that let me shift to low cost passive funds.
Right.
So cost of course is one element, but that is not the only factor.
Right.
There are many other elements which are leading to the drive of passive funds, and I strongly believe today, if you just look at actual numbers, today entire Indian mutual fund industry is close to about 38-39 lakh crores.
Right.
From that now, the ETFs and index funds have crossed 5 lakh crores, means approximately 13% of the total AUM. I believe very strongly in the growth of this segment, and maybe by 2025, this will grow to approximately 25% of the total AUM.
Right. So I completely agree with you, especially on as it is free from human biases and low input cost. But as an investor who wants to invest in ETF, many times they are wrongly advised saying that ETFs are risk free. I mean, I believe that no products are risk free, but I just want to know, do you feel that is it that case like?
Well, absolutely not, because if the underlying asset class of that ETF is equities,
Right.
suppose you invest into a Nifty 50 ETF,
Right.
or something little bit fancy like you select a Nifty equal weight ETF, the underlying still is equity.
Right.
So wherever there is equity, of course there will be risks of downside, there will be risks of volatility. Yes, one thing I can say that there is one big risk which is eliminated from ETFs, that is the risk of human bias.
Right.
So to that extent, one can say that that element of risk is taken out of the equation, but overall mark-to-market risk, asset class risk, whether it's equity or if you invest in fixed income ETFs or commodities, definitely the risk of the underlying asset class will always remain there. And I think it's the role of responsible media houses like you and responsible manufacturers like us at DSP Mutual Fund that we need to constantly keep enhancing the awareness for the investors so that your readers and your viewers can get the clarity that okay, it is lesser risk to certain extent because there is no human bias involved, but yes, definitely there is a risk involved.
Right, so I aligned with you on this completely. So moving on to next question. SEBI has allowed the mutual fund companies to launch ELSS, equity linked savings scheme, that can be now passively managed. According to you, what this development means for the investors as well as the companies who will be managing these passive funds?
In my view, SEBI had come out with this very prudent and very good rule whereby they will permit passively managed ELSS. See, ELSS, what it does, in one way, it is encouraging investors by giving them tax incentive to park their money for long-term wealth creation. Now, in that long-term wealth creation journey, if you are able to have low-cost, transparent, passive funds, then definitely it's a very huge benefit for the investors' wealth creation. If in 1 year you are able to save even 30-40 basis point or 0.5% or 1% as a cost, then that cost accumulates over a long period in the ELSS long journey. So I feel that it's a very prudent move by SEBI to allow mutual funds to launch index funds on ELSS platform. Only thing is that as of now there is a restriction that for each fund house you can have either of the two. Means you can have either a actively managed ELSS or a passively managed ELSS. Now what has happened that larger part of the mutual fund industry which has been in existence for many years, they already have one ELSS fund. So I feel that it will take a little bit time for investors to actually be able to get this as a choice, but I am sure there are many fund houses and many innovative decisions are being made. So very soon I think so we'll see investors getting this choice of passive ELSS funds.
Fair enough. So my last question to you is, why is it crucial for a retail investor to make passive funds to be part of their core mutual fund portfolio? Because many times we have seen people, going towards active mutual funds. In their portfolio is mainly of equity mutual funds and as such. But do you think what percentage of passive mutual funds or ETF can be part of your portfolio as an investor?
Sure. I think structurally, if you look at it, we need to have a combination of both. Right. So I always tell people that whenever you are making any decisions, the power of and is much more than the or. Right. So instead of active or passive, let's use both. Right. Let's use ETFs and index funds as a complementary strategy in the overall portfolio of clients or as investors or individual people like you and me, whereby, let's say for example, after your overall asset allocation is determined that how much component you need to be in equities, how much in fixed income, some part has tactical allocation based on, let's say for example, current views on the capital markets and economy, that if one is expecting higher interest rates and more inflation, maybe at that point of time they want to go to securities or assets which are negatively correlated like real assets, including commodities, real estate, etc. Maybe for that tactical call also you can use ETFs in a very simple way. Maybe for your core allocation in long-term equities, some part of it you can park it in low-cost, large-cap equity funds which are running as an ongoing allocation. But for other areas, definitely I feel active funds will be still very relevant for allocation to, let's say, very small companies, pre-IPO type opportunities or alternatives. For that, we'll still need active management, and I feel India has a huge scope for generating outperformance. So that will remain as of now, but especially in large cap and multi cap space, little bit large and mid cap space, I feel that passively managed or not just plain vanilla passive, but rule based smart beta products also will do very good.
Fair enough, sir. So, sir, we'll end the session over here.
Sure.
So it was pleasure talking to you, and thank you so much for your time.
Thank you very much.